I'm sure you must have seen magicians do tricks. If not in real life, you would have definitely seen them on YouTube. We all know magic is nothing but an illusion that the magicians create to deceive us, but we still fall for it. In the world of finance, there are magicians who play tricks with numbers. They are so smooth that they can easily make a bad product look good. Not just that, they can even make a trap look like a convenience and an expensive instrument look cheap. And today, we are going to talk about how you can get fooled by this number jugglery and how you can save yourself. We are not talking about scams here. The data they show you is correct and factual. They operate within the regulations. Just that they show you numbers that are pleasing and leave out the painful parts. In this video, we will talk specifically about banking products. If you like it and give it a thumbs up, we will make similar videos on insurance and mutual funds. Hello and welcome to ET Money's YouTube channel. Before we start, a quick update. You are watching ET Money's English YouTube channel. We also have a Hindi channel जहां आप ये सब videos हिंदी में देख सकते हैं. And if you are someone or know someone who wants to understand the basics of managing and growing money in an interesting way, we have a channel called 5 Minute Finance, where we cover everything in under 5 minutes. So what does this video have for you? We will discuss the crucial numbers and calculations you must understand in 3 banking products. First, we will talk about home loans, then about credit cards, and finally about FDs. So let's begin with home loans. Many of us have a home loan. Many would be planning to take one. Indeed, with a home loan, it may be possible for most of us to buy a house. But despite paying EMIs regularly, your principal amount might not come down. Let's understand this with an example. Let's say you take a home loan of 1 crore for 25 years at 8.5%. Your EMI comes to about 80,000 or 9,66,000 for the year. You pay all the EMIs for the first year. You check your outstanding principal and it still stands at 99 lakh. You are confused. Didn't you just pay 10 lakh in EMIs for the year? Why is your principal amount almost intact then? Let us explain. Home loan EMIs calculations are done on the basis of reducing balance method. In this method, the interest is calculated on the principal remaining at a point in time. This differs from simple interest, which is calculated on entire principal. So the interest is lower in the case of reducing balance method. For instance, for a 1 lakh rupee, a simple interest of 8% for 1 year is 8,000. At an 8% reducing balance interest rate, the principal payable will be 4,386. Now, in terms of reducing balance, it would require an interest rate of 14.5% for the amount to be about 8,000. Sometimes, salespeople try to deceive people by saying that instead of 14.5% prevailing interest rate, the loan is available to you at just 8%. That 14.5% interest rate is in terms of reducing balance. The 8% is in terms of simple interest. So mathematically, both of them are the same numbers. Now, since the EMIs are calculated as per the reducing balance method, the interest component constitutes a significant part of them in the initial years. But as the time passes, the principal portion starts becoming larger and the interest component reduces. Take a look at the table on your screen for the structure of EMIs for a 1 crore loan for 25 years at 8.5% interest rate. Pay attention to the interest and principal columns of the table. The interest is larger in the initial years and the principal is larger in the later years. That's why your principal component won't be reducing during the initial years. That also means it's better to prepay your home loan during the initial years than say after paying EMIs for 10 or 12 years. That way, you can save the interest outgo. During the later years, if you prepay, you are paying back mostly the principal. So there is limited savings on the interest outgo. For instance, for the same home loan, if you prepay 2 lakh after paying 12 installments, you will save 12.45 lakhs in interest and the total loan tenure will be reduced to 23 years and 7 months. However, if you prepay 2 lakh after paying 120 installments, you will save only 5 lakh rupees in interest and your total loan tenure will reduce to just 24 years and 4 months. So if you do plan to prepay, do so during the early years of your loan to save the interest outgo. Let's say you took a home loan a few years ago. At that time, the interest rates weren't as high as they are now. So your EMI for a loan of say 50 lakh at 6.6% interest rate for 20 years would have come to about 37,000. Then interest rates started to go up. Your bank kept your EMIs unchanged, so the loan tenure continued until it became more than 100 years. 100 years. Take a look at the table on your screen. It shows you how your tenure changes if your EMI is kept at the same level. But why does it happen? Because when you keep the EMIs unchanged, there comes a point when the interest is greater than the EMI itself. So the remaining interest starts to add to your principal and the principal begins to increase. In effect, your outstanding principal starts to go up and keeps attracting more interest. This whole phenomena is called negative amortization. Of course, you have a few ways available to you to circumvent the impact of rising interest rates. The first is that you can increase your EMIs when the interest rates go up. That will ensure you don't increase your tenure. Of course, it will increase your EMI outgo and may stretch your finances. Also, the bank may not allow you to shift to a lower EMI later on. The second way is to increase your EMI and your tenure in such a way that increased EMIs don't overburden you. If you do so and the interest rate rises to 9.1, your loan tenure will increase from 20 years to 27 years and 2 months. Your EMI will increase from 37,000 to about 41,000. Now the third option is that you prepay part of your loan. That will help decrease the tenure and offset some of the impact of a rise in tenure. If you are disciplined and make part lump sum prepayments, you can reduce your loan tenure and the interest outgo significantly. So if you prepay 2 lakh rupee every year, you can reduce your tenure from 20 years to 11 years. In the process, you can save over 27 lakh in interest as well. Now, a couple of recent announcements by the RBI has made home loan borrowers' life easier. In an August 2023 notification, the RBI said that home loan borrowers must be given the choice to opt for A, enhancement in EMI or elongation of tenure or a combination of both options, and B, to prepay either in part or in full at any point during the tenure of the loan. Banks and NBFCs must also provide an option to floating rate loan borrowers to move to fixed rate interest rates at the time of resetting the loan. They must ensure that an increase in loan tenure does not result in negative amortization. So don't worry, you won't get into 100-year loan scenario. Yet another option is to negotiate a lower interest rate with your bank. Banks often offer a lower interest rate to our new customers, so you can try migrating to a lower interest rate. If your bank doesn't agree, you can consider transferring your loans to another bank or NBFC. Last but not the least, you can simply wait for the interest rate cycle to ease. As interest rates fall in the economy, your EMIs will also come down. Now, let's move to credit cards. If you are someone who uses credit cards regularly, this might surprise you. If you forget to pay a small amount of say 100 or 200 on your credit card, the penalty next month could run into thousands. Let me give an example to further elaborate on what I mean. Suppose you have a credit card dues of 50,100. Before the due date, you pay 50,000. Now 100 is outstanding on your credit card. You may think this doesn't matter much. After all, you get a 45-day interest-free period. But that's not how it works. If you have an outstanding, the interest-free period is no longer available to you. The credit card company will start charging you interest on a daily basis if you have an outstanding. Let's say you spend 30,000 next month. Along with the previous outstanding amount of 100, the total dues are now 30,100. This entire amount is subject to interest. At 3.5% monthly interest, you will need to pay 1,000 rupees. Plus, you will need to pay 18% on this interest. So the total interest comes out to be 1,200. Effectively, because of not paying the outstanding dues of 100, you had to pay interest of 1,200. But what if you paid 25,000 of the 50,100 dues at the end of the settlement period? Now you will pay 3.5% interest rate on the rolled over dues of 25,100 plus on the new expenditure of 30,000 plus the GST. That comes to 2,200 bucks. So paying your outstanding on the time is strongly recommended. Banks also allow you to pay the minimum amount due on your credit card and transfer the remaining balance to the next month. This can quickly land you in a debt trap. Suppose you have a credit card outstanding of 50,000. The minimum dues are often 5% of the outstanding dues, so they'll be around 2,500. You pay the minimum dues and roll over the remaining amount to the next month. Next month, you do that again. You spend 50,000 using your credit card, pay minimum dues and roll over the remaining amount to the next month. You keep doing it for several months. At the end of the 10th month, you would still have dues about 4.75 lakh. And in this period, you would have paid over 1 lakh rupee in interest and GST. You see, the principal of 5 lakh has not moved much here. However, you've already paid over 1 lakh rupee in interest. That's how you get into debt and an interest trap. Let me give another quick example. Let's say someone buys a 50,000 rupee phone on a credit card. The person only pays 5% minimum balance every month and nothing more. It will take between 30 to 40 years to completely pay off your outstanding depending on the interest rate on your credit card. So it's not enough to pay the minimum amount due alone. Make sure you pay the full outstanding dues at the end of the settlement period. Let's now move to the next point, FDs. Which FD would you like to buy? One that has interest rate of 7%, or the one that has annualized yield of 7.19%, or one that has effective annualized yield of 8.3%. Did you see the last one, the one with an effective annualized yield of 8.3%? Well, all three FDs are actually the same. Let me explain why. The actual interest rate, that is 7%, is what your principal will earn. Now, FDs usually have a quarterly compounding frequency. That means of the 7% interest rate, 1.75%, that is 7% divided by 4, is added to your principal at the end of each quarter. At the end of the fourth quarter or the first year, the balance is 1,07,000. That's an annual return of 7.19%. It can also be called the annualized yield. Now, annualized yield is the rate at which your money grows every year. And then comes the effective annualized yield. If you see the corpus at the end of 5 years, it will be 1,41,478. You had invested 1 lakh. So your overall returns is 41.48% over 5 years. If you divide this number by 5, you will get an effective annualized yield of 8.3%. Thus, effective annualized yield means the average simple interest you made every year. The longer the tenure, the greater the effective annualized yield. So essentially, the same 7% interest rate gets translated into 7.19% annualized yield and 8.3% effective annualized yield due to the way compounding takes place. These are not three different numbers. So don't let banks pull the wool over your eyes. Don't fall for higher effective annualized yield, ask the actual interest rate instead. If you're comparing two FDs, compare just the interest rate. If you're comparing FDs with other products like bonds, then check how much your money will grow every year. For that, compare the FD's annualized yield with the per annum returns of the other products. And this brings us to the end of the video. What's the quick lesson here? In the world of finance, don't just go by the data and numbers that a salesperson shows you. There is no alternative to doing your own research. I hope you found this video useful. And if you did, don't forget to share it with your friends and family so that they also don't get fooled by numbers. And I'll see you with next video soon. Until then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.